Good morning, ladies and gentlemen. Well, the frustration is almost palpable because the market for the sixth week in a row has gone practically nowhere, both in equities and in bonds. And therefore, I think it would probably be useful to have a look fundamentally where we are and what the explanation for this calm might be, and also what might get us out of this very tight range that we've been in for the past 6 weeks. I always find it useful when things are really not moving to have a look at what the fundamentals are showing and therefore try to understand what could push us out of this range, and most probably is going to be some fundamental indicator which shows that the Fed is achieving its fight against inflation, it's achieving a win, and that therefore it can at some stage in the near future shift its policy. Since the beginning of the year, the 5-year forward inflation expectation rate has been very much stuck. This is where we started the year, and this is where we are now, within 1 or 2 basis points basically. And we've been in a very stable range. What this is telling me is that the market is comfortable expecting a rate of inflation slightly above of what the Fed's target is. It's not moving higher like it was moving at the beginning of last year. So at the moment, what the market is saying is the Fed is winning its fight, but not enough to basically get inflation down to 2%. And therefore, the tightness of the monetary policy is still warranted. If we have a look at what the 10-year break-even inflation rate is saying, it's slowly coming down. And that, to me, is saying that the market thinks that the Fed will achieve its target, but it's not achieving it yet. We are still not below 2%, and we are not breaking below 2%, but we are in a very narrow range above 2%, just like in the previous chart. If then we have a look at the market yield at constant maturity of a 10-year note, inflation indexed, it's still, at the same levels as we started the year. It's around 1.25%. That means that you are getting a real yield on your 10-year investment, and therefore that you should be very much happy to receive that yield and have a balanced portfolio between bonds and equities, and that bonds and equities are basically in some sort of an equilibrium here, because you're still getting a positive yield, i.e. we are no longer in the world of TINA, i.e. there is no alternative like we were down here, because down here you were getting a negative real interest rate, and therefore you had to go out on the risk spectrum to achieve a return. Here you are achieving a positive return that you haven't achieved for a very long time. If we go back in time, really the last times you were achieving these kinds of return was in 2010. And therefore the market is basically happy at these levels. The risk market can't really push ahead because there is an alternative. The bond market is showing you that the Fed is winning its fight, but not enough, and therefore bond yields can't come off yet. And therefore we are in some sort of a limbo, waiting for the inflation battle to be won. And until that happens, you really can't expect much lower yields, and therefore you can't expect a risk market which is roaring to the upside. And all this yields to the current yield curve. You can see here where we closed on Friday and where we closed the Friday before. Very small changes. And really the problem, if you can call it a problem, it's a reality rather than a problem, is that we have 5% Fed funds and that the 2 year can't really trade that much through it, because every time it does, the negative yield curve, it reaches some sort of yield level and people just get out of it. The 2 year pulls up the 3 year, which then pulls up the fives, etc., etc., etc. In this kind of situation, where you have this inversion and this hue, people tend to go and buy the 5 to 7 year belly to be able to basically give themselves time for the 2 year and the Fed funds basically to do its job on the economy, to squeeze inflation out, which is going to take a long time because the Fed keeps on telling you that it's going to take a long time. And once it's done, then the 2 year can come down and we can have another normal yield curve positively sloping, which we don't at the moment and we won't for a long time. So really what we have to concentrate on is the shape of the curve between the 2s and the 5s and the 5s to the 30s, because the 2s to the 5s is going to give us the timing of the disinversion. And the reason for the disinversion now, we don't know. Could it be that the economy gives in? It could be. It's highly unlikely at the moment because not a single real economic indicator shows you that the economy is weakening significantly. The question becomes, does the economy need to weaken significantly for inflation to return down to 2%? It probably needs to weaken some, but the extent of it is unknown, and that is something that we're going to learn from week to week. At the moment, all we can say is that real wages are growing, that spending is not slowing down, savings are still healthy, and I would suspect that before the disinversion takes place, we need to see a lower savings rate, a stop to the accelerating real wages, and a little bit of unemployment. Now, how much unemployment will be necessary, I have no idea, but certainly some extra unemployment that we're not seeing at the moment most probably will be necessary. This is the 2s, 5s, and as you can see, all week it just kept on going out. Very little, but then the market itself is moving very little. What, show me a single 10-year which moved more than 5 basis points on the week. Therefore, a 2s, 5s which actually moves out by 5 basis points is pretty significant. It just shows you that all the pressure is and remains on the 2s. And while we have this negative yield curve, the 2s can't really improve and stay improved relative to the rest of the curve. Therefore, I expect 2s, 5s to basically keep on going out as people keep on buying the belly of the curve for investment purposes, giving themselves time to be right in a year's time or 2 years' time when they expect the Fed to start easing. So 2s, 5s, and to a lesser extent 2s, 10s, will be stuck in a range but going northwards, while the 5s, 30s, as you can see, are clearly now in a descending phase. I would have thought that any move back up to this 29 to 19 area is going to be another very good opportunity to sell. And we are really looking for these kind of levels as targets next, between Let's call it minus 54 and minus 71. This is the kind of area that I would be looking for them to head to once we've tested the upside and we start coming down. We can't really expect the 530s to have huge ranges and certainly not impulsive moves to the downside now, simply because the fives are getting held back by the twos. If we go back to the twos fives so that you can understand, we would really need a big moves in twos fives to unhinge the fives and let them move freely, certainly against the 30s. That is not going to happen. At this stage, all we can expect is for the twos fives to slowly ratchet up and fill this gap over the course of the next couple of weeks. And that will give you, once we've achieved that level, that will probably give you the high point in fives yields. So if we look at this, fives basically go very slowly back up towards 361, slower than the twos go back up. And let's see where the twos can go, say 426. So the twos reach 426, the fives reach this 61 level, so they go 15 to 17 basis points, while the twos go up 26 basis points. You can see what I'm saying. The twos have to do the worst, enabling the fives to do slightly less worse, and probably the 30s do nothing, stay in this very tight range. That enables the yield curve to reach an upper equilibrium, and then we can repeat the cycle with the twos coming down, enabling the fives to come down in yield, while the 30s do nothing and the yield curve has another cycle. But it's all small cycles. Until the Fed unhinges the twos, nothing else can move very much. And that is why I'm not surprised to see this, which is basically the move index heading down towards the lows of the year. As the move index goes down towards the lows of the year, you get the VIX having no pressure on it, at the very least, if not downward pressure, and therefore vol targeting funds can basically buy more. As volatility comes down, they buy more, and that puts a floor under risk assets, and there you have it. That is the reason why nothing is really moving very much, and every time you get to lower levels in equities, there are plenty of buyers. Much the same situation is evident in Germany, with the added proviso that Germany is still 1 or 2 steps behind the US in its hiking cycle. The ECB was very clear that they are on a journey as opposed to having arrived at the destination, while the Fed could have arrived at the destination. I have seen nothing in the CPI data or PPI data last week to indicate to me that the Fed will hike again in June. It's still early. We still have at least one NFP and one CPI to come, and a whole slew of real economy data, starting with retail sales this week. So the situation with the Fed could change, but it could change for the worst. It's not going to change for the better, i.e. the likelihood that the Fed is going to pivot anytime soon. Before those fundamental indicators that I've showed you earlier start going down towards 2% and staying at 2% in terms of what the market expects in terms of inflation over the course of the next 5 years, I think those odds are almost zero, almost non-existent, and therefore it really just does not pay to even think about the Fed pivoting. Therefore, I think that the differentials between Germany and the US can only keep on coming in, i.e., a narrower differential between German rates and US rates. To me, if we see the 2 year coming down in terms of differentials, I think it's going to be a great, an absolutely great level to put it on, and we'll have a look at that in a moment. At the moment, you're getting the same picture in Germany in twos, fives, and tens as you are getting in the US. I think Germany is far more likely to go and test the 245 level in fives, and then subsequently this kind of area 245 to 250 area in the bunds. I think the likelihood of Germany being the leader on the way down is almost zero. And we'll have a look at the crosses. I think anywhere around here, around 145 in the twos, major sell. Fives, anywhere around 130, 140, 130 to 135, major opportunity to sell again. And the tens is probably the one which has achieved its level, but around here at 123, I would have thought the likelihood that we retest the 105 is far higher than we start going up towards 135. And really the 30s is the one that you can really almost bet on, that if we see this kind of level, 147, I will be putting it on in a major way. Again, for fundamental and technical reasons, it makes perfect sense that Germany should be the leader if we're going to get higher rates, and the US should be the leader if we're going to get lower rates, because they're just so much further along in the cycle. The dollar, well, it did better, despite the fact that I think that differentials are going to keep on coming in, interest rate differentials between the EU and the US, which would indicate a weaker dollar. You know, it is what it is. The dollar doesn't always follow different interest rate differentials, but it only can have sustained and impulsive moves when the inflation differentials are in its favor. What I think is happening is, normal trading. People got far too short down at the lows, and now they're getting stopped out. What it tells me is that playing the dollar from the long side, if I'm correct and inflation differentials keep on coming in, is not a long-term play. It's a trading play. And why not? There's nothing wrong with trading the market, but it just tells me not to get too bullsed up at higher levels. Let's face it, we didn't even break 102.82 on a closing basis, so it's not like the dollar is going a million miles. It is showing signs of strength when it should be showing signs of weakness, and that is a big warning flag that it could do a quick stop run, but I don't think it's going to last. Let's have a look at Euro USD. Could Euro USD come down to these levels around the 107.25? Yeah, absolutely it could. But is that a sustained move, and is that going to be a sustainable move? I think all we're getting is a retracement of this move, which will stop somewhere around here, and then the inflation differentials are going to reassert themselves, and we go and test the highs again. That is my bias. I could be badly wrong, But to me, as I said at the beginning, any kind of dollar move which is not matched by inflation differentials is by definition a short-term counter trend move. Gold, I still don't like until and unless it starts breaking on a weekly basis 2045. I still think it's far more likely to trade down to 1958, 59 rather than keep on going up. I see absolutely no reason why gold should be very well bid at the moment. Bonds are doing nothing and will continue to do nothing, as I indicated to you earlier. The um, the dollar, it did better, right? So that's not hugely supportive of gold. So I'm not a buyer of gold. I have traded it pretty well so far. I gave you all the important levels and where to get long and where to get short. And I think 2045, for the time being, is a level to get short. There's nothing on the weekly charts that tells me we're in an impulsive phase. And there's absolutely nothing in the daily charts which tells me that we are not going to retest the downsides, because there is absolutely nothing that's telling me that commodities are under any kind of pressure. DBC basically keeps on failing and closing towards the lows of the week all the time. It failed miserably up here at 24.39, and don't forget DBC is mostly oil. This kind of a failure, I think, leads to the targets of the ABC, which are between 2175 and 2058. Now, if we get that over the course of the next month, that will have actually negated, or let's not call it negated, but worked off the whole of the 2022 move higher in commodities. Now, that has to be good news for inflation. That has to be good news for bonds. And that has to be bad news for bond substitutes with no yield like gold. If we have a look at oil, and here we are at the on a weekly chart, this is 2022 and this is where we are. Basically, we are back at the beginning. And I really think that what you are looking for is a huge flush between 64.23 and just below 60, and get everybody out, and then maybe the market can rally back up towards 75. But for the time being, I really see no impulsion in oil whatsoever. I see bearishness in DBC, really no reason to buy commodities. And if there are no reasons to buy commodities, I don't think that there are many reasons to expect much higher inflation for the time being, and therefore any kind of reaction in the bonds. And therefore everything is saying that the current status quo in the bond market is going to last a little bit longer. Copper I don't show you very often, but I think it's becoming interesting. Copper is definitely the metal with the worst imbalances in terms of supply and demand, and what the current stocks in warehouses are. And therefore definitely the kind of metal which has the most upside potential at some stage. The first chart here is gold against copper, a favorite of many bond traders, where they try to have a look and see where bond yields should be going. Well, this is indicating much lower bond yields, because let's face it, we are at the same levels as we were at the beginning of 2021 when bonds were, yielding just about zippo. So it led significantly the move, saying that rates were going to go up. It was correct eventually after a long, long time of just leading and it going nowhere. And now it's showing again that bond rates should go down. What is interesting to me is that we've turned the 200-day moving average higher, but we are breaking below very important levels on the daily chart, indicating to me that we will trade lower. Not that I want to sell it, but that I want to buy it. Where would I want to buy it? This is the level that I'm interested at, 3.5005, and that is where actually I have a bid in, and this is where I think the risk reward becomes overwhelming for another move to the upside. I don't know what copper is indicating. I just know that I probably want to own for the long term something which has very bad imbalances in terms of supply and demand, and that the odds of me getting very hurt by buying at 3.5 are not huge, and I own none as it is, so owning some is not a bad idea. That's definitely the kind of level that I will find interesting. I don't know what to make of gold copper. It's definitely leading bond yields down at some stage. Could this be indicating some kind of a weakness in metals due to a recession? Could be. I would rather bet that we are that there are some very bad imbalances in people's positions. We all know of the funds that were very long oil that are blowing up or have blown up. And I suspect the same thing is true in industrial metals and in many other commodities, that we're getting a liquidation phase as opposed to anything else, due to financial conditions and financial imbalances rather than any kind of huge weakness in the world economy. Anyway, that's my bet, and my level is 3.50005. No weakness at all at the moment in the Blue Angels. They keep on turning higher, showing that expectations of future earnings are improving. Now, it's extremely unlikely that these can keep on improving and that industrial metals and oil and so on can go into a protracted bear market, which is another reason why I think that when it dips, when either copper dips or oil dips to the levels that I've shown you, the risk reward should be to the upside. Because at the moment, look, you know, there is an alternative, as I showed you at the beginning. The alternative is called a real yield. And therefore, I think it's unlikely that we start accelerating away from this times 18 line, but rather following it slowly to the upside as it crawls up. If people can get a real yield and they don't think the economy is going to accelerate away, and let's face it, the likelihood of the economy accelerating away with rates at 5% is not very good. Therefore, all you can hope for is to time a Fed flip. But why should the Fed flip? The Fed is going to only flip if the economy has an accident, in which case you don't want to be long of equities, or if the fight against inflation is won, and that we won't know for a very long time. So I think that this kind of quiet period with the market just sticking to this times 18 line, because bonds are not going to move a million miles, not unless we get a reacceleration of inflation. And I can't see that happening with what's happening in the world of commodities. And that gives you the reason why we're stuck. I feel almost ashamed showing you these charts because so little is going on. And what to say about a market that was basically stuck between 4100 and 4144 all week, i.e., less than a percent move. It's endless rotation. It's rotation out of one sector into next, but the overarching theme is that technology just won't go down, or that every time it goes down on profit taking, some other sector comes in and basically stops SPX from going down too hard. What can I say about this? Until we see a break, a sustained break, and a at least one or two closes over 41.64, I just can't get excited about the upside. But every time it dips down, you want to be a seller of puts. Because let's face it, this market is slowly improving. The 200 period moving average, which was coming down, is now turning up. All the moving averages. Let's have a look at a daily chart, uh, which will be even clear. I mean, look at all these moving average are now supporting. Not that I think that we will get to these levels, because what's that, 39.80 or something like that. Uh, we are getting normalization in every single indicator, which shows you that at some stage, for some reason, we will be ready to start moving up. That time might not be at the moment, but if we have a look at a whole slew uh, of other indices like YM, that is just also not bearish, even though the whole week it was under pressure. It just shows you what I've been saying a moment ago, is that one sector starts leading, then that sector stops, and some other sectors take over while a third sector is weak. Now, last week we had weakness in YM, but anything and until it starts breaking 32,578, this is not a bearish chart. This is, there will be buyers on these dips, and all that's going to do is lead SPX down 20, 30 points, when then NQ, which we can have a look next, is going to take up the pressure again, because it'll be down here and start going back up and basically take up the leadership role. These are just not bearish chart to me, unless we start breaking 12,783. There is nothing bearish about NQ, the little weakness it had on Friday. That was absolutely nothing. We have our levels, we have our fundamental reasoning as well why this market is not going down, as I showed you in the Blue Angels. What we need is a change in the economic data that's coming out. And really, have we seen any weak economic data come out? Why would it be surprising in that case that as firms readjust to this, to this period, and they reestablish their supply chains, that they can actually squeeze some extra profit margin and therefore get their earnings expectations to start going up. It's not hugely surprising. I don't think it's going to last forever, but it just shows, it just tells you that this period of consolidation with higher prices, because you should never sell a quiet market, is not really all that unreasonable. I think 37.64, or a percent or so lower than that, is a very good risk reward in EEM. I don't think that this weakness will persist. I think by the end of the year we will see 42.03 or 42.25 again in EEM, and therefore I will be adding, rather buying, because I haven't got any at the moment, EEM at anywhere below 37.64. I think that's a very good risk reward in terms of for the rest of the year. And the one other market that I wanted to show you is the fact that Nikkei is breaking higher. Now, if we have a look here, you will see that 30,205 is actually the high close of this whole move since 5 years ago. So it shows you that there is strength in certain markets, and really not to get too wedded to a recessionary narrative. I doubt that the Nikkei would be this strong unless there was some fundamental strength in some markets somewhere. And that just sort of fits in with the narrative that I don't think that copper is down because of recessionary fears. I think it's down because of a failure of positioning, or people were just too aggressively positioned for China reopening or whatever narrative they were wed to. So it just tells me that there is strength in these markets. And I find it very hard to believe that anybody can think that this, behavior in Europe, and whether it be DAX or the stocks, is really an indicator of a developing bear market in anything. Could we get several more weeks of stability and possibly even gap filling down towards 41.27? We could, but it still doesn't lead you to believe that we are at the beginning of a recessionary cycle, that stocks should be much weaker than they are as a result. Therefore, I just look at these dips in anything as opportunities to sell puts or buy call spreads, rather than get aggressively short, simply because I'm just not buying this recessionary narrative at the moment. And I think if there was a recessionary narrative, VIX would indicate it and would not be trading all week between, let's call it 16 and quarter and 18. This kind of behavior by the VIX indicates to me that it's more likely to break down rather than break up. And since we know that we have an expiry on Wednesday of the month of May, it's likely to do it into May's expiry, and then trade up if it's going to trade up at all. So I don't think, in summary, that we are going to get an exciting week. I think that any kind of weakness in the commodities that I showed you and or in equities is a buy for a bounce, simply because I don't think the timing for any kind of recessionary story is anytime soon. And with that, to the summary sheet, I've updated all the levels, the little there was to update. I think over the course of the next couple of weeks, apart from selling puts every time equities fall, I think the only other thing that you can do profitably is look for levels to buy EM, as I indicated to you, and also levels for industrial metals like copper and oil and DBC when they get to ridiculously oversold levels and when everybody starts getting bearish on them. I think the likelihood of them staying below the 2022 levels where we started in terms of risk reward are very low. And at some stage over the rest of the year, you will see a significant bounce. So I think preempting that is interesting. And, finally, a Nikkei, which is going to its highs at 30,205, is not indicative of a world economy which is about to collapse. I'm sorry, it just isn't. And that to me says that risk is going to get bid every time there is a dip in it. Thank you very much indeed, and tweet you on Monday.